Welcome to IA Investment Management's first fixed income update for 2023. My name is Rose Marcello, and I'm Director Client Portfolio Manager with iAIM. Today, I'm speaking with Dominic Siciliano, who is our Senior Vice President, Head of Public Fixed Income. He leads the fixed income strategy for both rates and corporate bonds at iAIM. Hi, Dominic. How are you today?
Hey Rose, it's great to be here. Thanks for having me.
Always a pleasure. Listen, it seems like the bond markets are in some sort of a bind. So we started the year with a dose of exuberance, expecting central banks to pivot much faster than they were willing to do. But then first, we had strong economic data and central bankers who told us again and again that they were resolved in adjusting rates higher to fight off inflation. So rates readjusted higher. But then in a span of 2 weeks, something happened. We had three bank failures, and regulatory authorities had to step in to assuage the market's fear of contagion. And what happened is that bond yields rallied, and we started pricing rate cuts once more. Now, this past week has been a bit more, things seem to be under control, but bond volatility is still quite high. In your opinion, where do we go from here when it comes to policy rates?
Yeah, so it's an interesting question. I think you gave a really good synopsis of the situation. And the central banks have to fight inflation, but they also have to maintain financial stability. So the last couple of weeks, it's been a huge test on the Fed and the government's ability to bring back, I would say, some security into the financial markets. And I think that we could be critical sometimes of the agencies and the Fed, but I believe they did a great job in terms of reassuring the markets and putting in the right plan. So the Fed has several tools that they can use, but I think that the market's a bit of ahead of its skis in the sense that it's thinking that it's automatic rate cuts for the market. I think that they can keep rates high to combat inflation because inflation, even if it's slowing, it's still way above the 2% consensus, 2.5% consensus or target of the Fed. So they need to keep rates higher, and they could use balance sheet measures to provide liquidity and security for investors in the marketplaces. So I think that we're pricing in rate cuts even this today. The market's even more aggressively, but let's say 50 basis points of rate cuts by the end of 2023. Unless we were to hit a major recession, I don't think that's probably what happens. I think that the Fed probably keeps rates where they are here. The historical context also from the Volcker years, prior to the Volcker years, is that they've learned that, once you've got a handle on inflation, you have to really choke it. So I think they really want to maintain pressure. So if we have some stability, no more bad news in terms of the financial aspects, and we don't have a major recession, I think the rates probably stay at these levels, plus or minus, maybe the 50 that we're
Mhm.
pricing in the marketplace. But I think ultimately, it's not. We're not going to go back to sub 2% in Fed policy until inflation goes below 2%. And I think that's something where the market might be a bit ahead of its skis, thinking, oh, we're going to have a quick turn because of a recession possibility.
Good. So given the levels of rate is still very interesting for investors to be in the asset class. Um, After that episode of banking stress, many are now expecting lending conditions to further tighten. Is there a potential of spillover in the real economy for regular folks, if we could say? But also, what could be the impact for credit markets?
Yeah, I think in the US market particularly, I mean, in Canada, I think we've seen some tightening in lending conditions. It's anecdotal, but we do hear it from investors. In the US, whenever you have a crisis like we had, there's obviously a regulatory breakdown somewhere. Somebody wasn't aware of a certain risk or liquidity measures. I think the particular cases of these banks, it's a run on the bank, which was driven more uh, you know, by some bad risk management internally, but that's going to lead to more regulation, and more regulation usually means tighter capital conditions for the banks, which means tougher lending also. So that's going to have an impact, not directly in the next couple of weeks, but as we move towards that, especially in the US, it'll be more difficult to get a loan. Investments might slow. The story also is like this self-fulfilling prophecy. We see people still consuming. I mean, the economy is still running along pretty well. People still have cash, which is maybe surprising a few, but the fear of the recession might slow down companies' willingness to be aggressive in terms of their expansions or all the new capex they had also. So I think that's something else. As people say, well, let's wait and see what's going to happen. It might be a bit of a self-fulfilling prophecy. I still think unless we have some kind of liquidity situation or crisis, before we start talking about recession, we've still got a while to go, but we do feel there's a bit of a slowing there in terms. So yeah, and then that's going to affect, especially for Canadian banks, if the lending conditions are more difficult and there's less investment. You could argue maybe that banks' profitability might drop a little bit if that's possible in Canada, because the banks always do well, but maybe the profitability becomes a little bit more difficult for them too. So that's something else to look at in your portfolio. But yeah, that's definitely a trend that we're seeing in the marketplace.
Good to know. Well, and even though, despite those risks or fears, what we've seen is that both investment grade credit spreads, even high yield credit spreads, are still below historical levels for pre-recession time, if there is actually a recession coming up. Considering that risks, do you think markets are being too complacent?
Well, it's interesting because when we look at the spread or how much you get paid above a government security or a AAA security, you could say, yeah, you make the argument. It's pretty risk on, if you like, or it's very tight. But the total return, what you're getting in terms of compensation for total return, is probably the highest we've seen in a long, long time. So I think there's a bit of a balance there in terms of clients saying, well, it is a more risky environment, but I can go and get a 5% coupon in a corporate bond, 6%. So it becomes interesting in terms of total return. And when we invest in bonds, and for a refresher for the bond investors and our clients, you get bonds are evaluated according to two components, if you like. There is the coupon, which is what is paid to you, twice a year, and then there's the aspect of its sensitivity, the price sensitivity of the bond itself, the capital gain, if you like, in terms of the bond. So here we're at a good inflection point for good quality credit because you're actually getting a coupon. So if rates go higher, you sort of have some protection against a higher rate. And if you think that the recession story is going to happen, well, rates go lower. And I think even if spreads would go a little bit wider, I think the total return sort of makes sense at these levels. So in our portfolios, what we like is high quality IG. I think you have to do your homework because usually when you hit a recession, you do have a slew of downgrades when that happens. So not all credits are equal. And we have a pretty deep team that does all the analytic work to find out where there's value. And I think you have to be careful maybe with high yield, levered loans, some of the other credits. I mean, if you have a great manager and he's watching it for you, it's a good place to be. But I think those markets are maybe more sensitive to an explosion if we hit a recession, because they could move a lot more wider than the IG is in relative terms. So that's something that we're keeping some powder dry, if you like, in our portfolios. And if we do have that scenario happen, we're going to exploit and try to jump into the marketplace in terms of timing when it is to get back into those marketplaces, whether it's lever loan, high yield, or triple Bs that are maybe on the fringe of being downgraded. So we're going to keep some powder dry for the next couple of quarters.
Okay, so really two forces at play here. First is just general level of rates are still making the point for credit because we're getting the coupons are pretty high, but also is that we didn't actively manage mandates like the ones we have. Is that we have still a strong bias towards quality, and that's sort of cushion for investors at this point.
That's correct, and I think investors were probably right, and I think in my podcast I've always been transparent with this. I think having your money guaranteed at a certain rate for a year, it made sense, especially if you had cash flows or expenses coming up. But if you look at the total return of the bond market, and I'm just speculating today because the market rallies so much, but the index is going to give you about 4% return in about 3 months of investing. So it's been a good ride, a good run on the fixed end. Probably what a guarantee pays you over a year, we've made it in about 3 months, give or take, depending what rate you had there. So it's all dependent on when you invested. So that's interesting for us, and I think that's the whole dynamic we just talked about between the coupon giving you a little bit of protection and the all-in yield looking very interesting. So we're cautious, but we're very constructive on bonds. But bond managers, we never sleep. We're always worried about everything. So we'll continue to keep an eye on our clients' money and hopefully make good decisions for them.
Good. Thank you so much. Always very useful to have those conversations.
Always a pleasure, Rose. Thank you so much.
Thank you.